This is our Forex blog for June 12th, 2012. And like we do most days, we want to buy the strongest currencies versus the weakest using a currency meter. This shows each of the currencies compared to all the rest of them statistically on multiple different time frames. The real-time histogram is made up of 5 different tools averaged together. 3 of them show the direction up or down the yen, in this case is going versus all the rest, and the other 2 show the intensity. And then underneath that we have the 15-minute trend, hourly trend, daily, weekly, monthly. Obviously it makes common sense. The more trends that are up or down in this case, the better. This is also our new sortable currency meter, which allows you to sort from strongest to weakest. And so you can always focus on the strongest pairs. The New Zealand is going up against 100% of other currencies. On the hourly basis, the pound, the CAD are the strongest. The yen, Swiss, and euro are the weakest, and the dollar is the 4th weakest. So basically, in a nutshell, you want to buy the strongest ones versus the weak and sell the weakest versus the strong. We've created a simple, easy 4-step system off of this, and I'm going to briefly go over. I've gone over it more in depth in past video blogs. So step 1 of our 3-step Forex easy trading system is use a currency meter or a sorted currency hot list or quote sheet to find the strongest currencies that you want to look for buys and the weakest ones to look for sells. Common sense. Step 2, wait. Too many traders are impatient. They're also gamblers by nature. You need patience and discipline. Trading is not gambling. In gambling, usually your wins are about the same size as your losses. Trading, your wins can be significantly bigger than your losses, and that's key. You want to take trades that are likely to give you 2 times or 3 times bigger wins than what your risk is. This is what most new traders don't do. They have either too many losses or their wins are very, very small. So by waiting, finding the strongest currencies, waiting, then you just simply wait for buy signals. And you buy once the signal shows up when the price goes 1 pip above the previous bar's high. Or if you're not so sure about the trade, wait for the trailing stop to get hit and flip down below price and turn green, then buy. You can avoid a lot of losses by waiting for the trailing stop to get hit. Or for the weak currencies, you sell when a sell signal shows up and price goes 1 pip below the previous bar's low. And then for exits, new traders, inexperienced traders, or those with smaller accounts, 25 to 50,000 or less, should use trailing stops for your entire exit. If you have a bigger account and you're trading more lots, you should exit half when it hits the first support resistance area. Support is an area that there's likely to be buying, so when you sell, that's an area that you want to exit half, and resistance is an area there's likely to be some selling. I typically always draw my fibs on the previous swing up, and I will get out of my trade at the Fibonacci profit target, usually in the first half, and then I use the trailing stop in the second half. So here's some areas of key support resistance in order that I think that they're most significant. You can pause the video and take a look at those, jot them down. I've gone over in more detail in previous videos. And one other thing to realize is when you draw your fibs, the fib target, the 1.618 fib target usually is the maximum profit you're going to get. So it might go 5, 10, 15, and sometimes even 20 or 30 pips above that. But the first sign of it stalling, when it gets beyond that, get out. And also markets almost never go beyond the 2.0 level. Now that's only the case when you draw your fibs on a big swing, like 35, 40, 50 pips or more. And that means the next wave up is 50 pips higher than the previous high. And usually there's some pullback on the first swing too. So, it's a very significantly far away level. So when it gets to the 2.0 level, installs, exit your trade, don't be greedy. All right, so today we see the New Zealand, especially earlier today, very strong on all time frames. Pound, strong on all time frames except the monthly. CAD, real-time strength is strong, very strong trends on the 15 and hourly. The daily, weekly, monthly trend is still down earlier in the day. Most people trade against the yen or the dollar, so we will scroll the yen back and take a look. This one had some weakness and a little bit of strength. Notice strength followed by very little strength usually precedes a resumption of the previous strong downtrend. You can see the hourly trend is still strong down. The daily trend just shifted up. The weekly and monthly are somewhat down. And so 430 right here is a good time to be looking to sell the yen. And the New Zealand's already strong at that time. And at 430, this one's actually a little bit weak, so you would pick the New Zealand. The New Zealand yen, you're looking for buys around 430. So here's a little bit even before 4:30. We can see some buy signals right here. If you wait for the trailing stop to get hit, you're in here at 40. Trailing stop gets you out here at 66. You made 26 pips. And this is exactly why I draw my fibs too. It appears that the market just touched the fib level, and this is exactly why I exit half my trade at the fib target, or if there's another resistance area up there, if it comes up there and stalls and just touches it and comes down, you want to get out. You probably would never get the top tick, but you might get out at 71 and then the other half here at 65. You made another 6 pips on your first half of the trade. This is the whole reason why I do this, and it only works if you have a big enough, if you only do one mini lot trade. It doesn't make any sense to exit half of a mini lot. You know, this is for traders that are doing a couple lots at a time, 3, 4, 5. Try to pick lot sizes that are, you know, evenly divisible. Or if you do 5 lots, exit 2 or 3 at the first time, and then the remainder. If you really think it's going to continue on, the momentum's there, you know, hang on. In this case, the fib target's also at our upper containment band, which usually contains price. You can see it went a little bit underneath there, then shot up. These are areas where, you know, they're called containment bands for a reason. So you would probably want to exit if you had 5 lots on here, you know, 3 or 4 of them, and then let the trailing stop get out of the rest. Once the market makes a big move up like that, usually I wait for a little bit more of a pullback, like, you know, this pulls back, comes down again. I might have bought this one right here in the second pullback when it went 1 pip above the high. If your likely potential profit is up here at 74, buying it right here at 66 doesn't make any sense. You're only going to make 8 pips, and you're probably going to risk 8 or 12 pips. So never take a trade that's not likely to give you at least 1.5 to 2 times bigger wins. So this one pulls back. You got the signal right here. You're in here at 60. I always put my stop underneath. That bar's low by a pip. It kind of goes up. It almost stops you out, and then it shoots up. And again, it goes up right to the upper containment band, runs out of steam. You get out of half, and then it looks like the trailing stop got you out a little bit lower. And then I'd wait for a little bit bigger pullback like this right here. I would have got into this one right here, and unfortunately that trade didn't work. Would have had a loss. Hourly moving average is usually a good place to get into a trade, especially earlier when it broke out, came down and found support here. Good place to get into a trade. Nice, you know, 15, 20 pip profit there. Let's look at some other examples of our software in action. The pound was also strong last night, but not across all time frames until a little bit later in the day. When you start seeing patterns where you have a lot of strength followed by very little weakness, and then that strength comes back, it's usually going to last for an hour, hour and a half, 2 hours sometimes. And you can see at that time the hourly trend also shifted up. 6:30 is a good place to be looking for pound buys, and you can see at 6:30 right here, the yen is still weak as ever, so we're looking for pound yen buys. Let's scroll this back, and there's actually a little bit of a buy a little bit before that. Here's 6:30. It's really close to the upper containment band. This is one of those calls where it's not likely to go too many pips up, maybe 20 or 30 at the most, unless, you know, crazy intense, you know, 1 time a week type of trends come into the market, which are unlikely. So with this buy signal, I'm not going to wait for the trailing stop to get hit. I'm going to get in when it goes 1 pip above the high here, maybe at 50. Put my stop underneath this bar's low by a pip or 2. And we almost got stopped out, and then it shot up again. And because I don't expect it to go too far, I'm going to draw my fibs off this tiny wave. And you can see it came up to that level. It's above the the red containment band right near one of my Fibonacci retracement levels. It's also at the 1.382 fib target, and again, you can very easily see why I always exit half my trades at that level. I'd be in this trade right here at 50, out of half at 74, and then, you know, with this kind of strength, I would have definitely only exited half, and unfortunately it came down and stopped me out right here at 66. So I made another 6 pips on the first half than I did the second half. But some days you make 30 more pips on the second half than you do the first. So, and it's also a psychologically easy way of trading, knowing that you're going to get out of half your trade most of the time relatively soon, and then you can hang on to a much tinier position. It's very hard for me, and this is why I do it. If you can hang on to your entire position, in many, you know, it's one of those strong trend days, you're going to make a lot more money than someone who, like me, gets out of half. But on days where the market doesn't go after the first support resistance area hits, I'm going to, you know, do better on those days. And there's a lot more days like those than there are crazy trend days. So you're going to have to make an extra 50 or 80 pips on those big trend days to catch up, I think. and that's why I trade the way I do always. Last but not least, the Swiss was weak yesterday and the dollar was strong, so there's obviously some continuation today. The Swiss gets really, really weak right here. The dollar, unfortunately, does not have that much strength, but compared to the Swiss, it's obviously a lot less weaker, and at least its monthly trend is up. So at 9:30, when some strength comes in, or even waiting for the 15-minute trend to switch here, you might look for a 10 or 15 or 20 pip trade. You're not going to likely catch big 30 to 50 pip moves when one currency is super weak and the other one, has not been strong that day. You would have been better off trading the Swiss, especially earlier, versus the New Zealand. Actually, the Swiss starts getting weak right here a little bit before 8. Let's just take a look at the dollar Swiss. Here's 8 o'clock. Price is actually underneath the hourly moving average because the dollar was earlier today weaker than the Swiss. And this is one of those things where you're better off buying above the hourly. It didn't move above the hourly, then pull back, which gives us our buy signals. And I don't like to buy after it's already went up, pulled back, went up, went sideways, went up. This is a third wave up, which usually is the end of the move. And we always know that the fib target's usually the end of the move. Look at this, 1.618, which is what I said in the beginning. Usually that's the maximum move. So there's no way I'm going to take a trade here at 41 where my maximum likely profit target's 49. Again, it doesn't make sense. So sometimes you see currencies that show up in the currency meter where common sense dictates if you're not likely, we're not gamblers, we're traders. If you're not likely to make 1.5 or 2 times more than what your risk is, you don't take the trade. And this was weak earlier in the day, so again, why take that trade? More than likely, if I was watching this, and it's impossible to code up every single good trade that I take, when it comes up here and it makes a higher high, pulls back, finds support here, tested the hourly twice. When it goes above this bar's high is where I would get in with my stop a few pips underneath the low, and then I would be looking to get out at those fib targets right here. So, probably in at 20, out somewhere up here at 46. Unfortunately, lower probability trades I don't mark up with patterns, and some patterns are hard to spot for a computer.